All right, so I dropped the resolution just a bit. Maybe that'll take care of a few of the sound loops. I think it's still readable, but if it's a cost benefit, right, which ties into what we're about to talk about, if the cost of reducing the resolution outweighs the benefit of providing a more clean sound file, then let me know. Anyway, so we're going to talk about the constraints, and this is kind of when we will deviate from what we optimally would like to do. One of these that the FASB considers that I've seen in practice a lot is the cost benefit. So in this case, though, right, not resolution and sound files, but here we're talking about any benefit that is derived from having the accounting information disclosed. So any benefit from informing the users of information about what's going on should exceed the cost of providing it. And I've seen the FASB issue a standard and then back off certain parts of that standard because they get the overwhelming feedback that this is simply too costly. So this is one that I do mention sometimes as we're going through the material. And like I said, it's been used to modify or change some standards that the FASB has put out. What are the costs involved? Well, preparation and accessing the information could be a potential cost to the company. Like maybe the systems they're imposing or all of the valuation checks that the company now is going to be responsible for handling become just monetarily too costly. Perhaps the cost could be something more along the lines of proprietary information, that the company feels like the cost of divulging a certain amount of information would be detrimental to their economic standing in some way, or proprietary information that is guarded by the company against industry competitors. More so, it tends to revolve around the monetary cost. The benefit would be the transparency of the disclosure. Are investors really using this information, which is something that accounting researchers such as myself who dabble in financial markets research look to see, like, is this standard changing the price reactions of investors? Is it changing the yields on bond issues and things of that nature? One definite large one is conservatism. Conservatism is actually no longer an official constraint, but what it tells us is that when two options exist and we can't decide, they would be equally probable, equally favorable under GAAP, then we should choose the one that understates assets and income. And that's going to be really a dual effect, as we're going to see as we look through the elements, that when I understate assets, it tends to reverberate into or echo onto the income statement as an understatement of income, or vice versa. And what some of the consequences of this become, in practice, is that we usually have an accelerated recognition of losses and expenses. So that means that we're going to recognize losses before we recognize a gain. We might have, the same situation, the same transaction. The only difference in the transaction is that in one scenario it's a loss, in the other scenario it would be a gain. Well, we would recognize losses immediately as soon as we know that they're likely to happen, but we may defer the gain until it actually happens in the future at some point. So we tend to understate in the current period net income based on these uncertain to be resolved in the future transactions. We'll recognize it in the current period when it's a loss, but we will defer it if it is a perhaps likely in the future gain until it actually happens. It leads to recognizing losses when gains in similar situations would not be recognized at all. So this one has more of a time relationship, like both are going to be recognized when they're going to be recognized. In the second situation, we are talking about absolutely never recognizing a gain, period. So that can happen sometimes, that asymmetric treatment between losses and gains, where we will recognize a loss, but the gain will just absolutely not happen. And when two outcomes are equally feasible, this one's probably the least likely, because it's going to be very rare that two options are just absolutely equal in their probability distribution. We will choose the reporting technique that will be least likely to overstate assets and income. So we're going to choose that which will understate assets and income. And this is, again, one of those really super important ones, for which I don't know why the FASB removed it. I think it was kind of silly, because there's still so many parts of accounting that deal with and are decided by this instance of conservatism in reporting. So let's look at the elements. Now here's where we start doing some definitions. And my big hope is that you make some note cards about this and start committing these to memory, because they're so important in terms of classifying, and not just, understanding a definition and classifying, but really getting into how the elements are tied together, like how assets can be tied to revenues and expenses, gains and losses, how revenues, expenses, gains and losses are tied into comprehensive income, why equity transactions never have revenues or never result in an income effect. So these are really important. And when you make these note cards, what doesn't tend to help is copying things word for word. Put it in your own words, and just cut and pasting and printing this out won't really help you, because when you're forced to put something in your own words, there's a reason why you don't want to do it. There's a reason why you just want to write down the exact definitions, and these are pulled exactly from the statements of financial accounting concepts. But when you have to synthesize something in your own words, you're actively dealing with it in your mind and putting it into a place where it'll be more likely to be used. You're now owning that information. You're not just memorizing a bunch of words that don't really mean anything to you. So assets, there's a long definition, but really I've underlined the important part of it. They're probable future economic benefits. So they're probable, they're not certain future economic benefits, but they pass a certain threshold in terms of likelihood to happen, and they will benefit the firm economically in the future. Liabilities are the opposite of assets, because they are the probable future sacrifices of economic benefits, right? So we have a future economic benefit, and then we have those things for which we might have to sacrifice economic benefits. Equity, this one tends to be one that gives people problems. It's not as cut and dry as an obligation or a resource. It is ownership, though, right? The residual interest in the assets of an entity that remain after deducting its liabilities. So the residual interest in assets after deducting liabilities, that sets up this idea that we're taking assets and subtracting off liabilities, because that gives us what remains after deducting our liabilities. And that is the ownership stake. In a business enterprise, the equity is the ownership interest. Why is it that that's the ownership interest? If a company is to go bankrupt in a bankruptcy proceeding, once bankruptcy is declared, who gets served first between creditors and investors? First, creditors take everything from the company. So they get first dibs on any of the resources of the company. Any of the bonds that a company owes have to be paid off prior to any of the owners, the shareholders of the company, getting any money. And then what's left over, the equity holders receive any remaining assets. But there's a pecking order amongst these two parties, in that the creditors, the people that allowed the company to borrow money, any remaining, not order, assets, the creditors get their share of money first, And then only if there is something left over will that be divided up proportionately amongst the folks that own common stock in the company. Equity, it can be commonly referred to as net assets, and that's derived from the accounting equation. All netting means is that we're taking assets and then netting or subtracting an amount from them. And I don't know why. Sometimes it seems like students have an issue with what the concept of netting means. Well, if we net something, right, we're passing it through a net, and only a little, whatever's not blocked by the net is what we have remaining. And so we net from assets, any liabilities, those go to creditors first, and then that is passed along to the equity holders. So those are values at a moment in time. One thing to remember is that this is a moment in time, and that correlates to balance sheet disclosures. Balance sheets are at a particular point in time, not over a period of time. Balance sheets are always phrased, the balance sheet at December 31st, 2022, something along those lines, so that we know, okay, if we took a picture of the company at that day, this is the amount of assets I would report, this is the amount of liabilities I would report, and as a result, this is the amount of equity that is in the company. The rest of these are no longer at a moment in time. The rest of these are flows. So we're not talking about freezing a picture. We're talking about, looking at the story as it plays forward over a period of time. Investments by owners, right? And both of these are owner transactions. And that sets them apart from any of these that follow after the two. So these are transactions with the owners. If we increase net assets, and we just decided that, hey, another name for net assets is equity, that has to be something that you start to understand as interchangeable, net assets, equity, of a company, resulting from transfers to it from other entities to obtain or increase their ownership. So someone is paying the company, and as a result of paying the company, what they're receiving is ownership interest. And if we're going to journalize this piece, what we're looking at in the company standpoint, the companies receive cash for some, and we're going to credit common stock or capital. Capital in the case of a proprietorship, a single owner, it might be capital hyphen partner one, that would be a partnership. But if we're talking about, I don't know why I keep dropping off letters, stock, we're talking about common stock in the case of a corporation, right? So that increases assets for the company, and constituently now, the result of increasing the assets of cash to the company is that now the company has additional owners, and therefore their ownership interest grew. Distributions to owners are decreases in net assets, which again we need to remember is equity, and that is as a result of the company distributing assets to its owners. Distributions to owners decrease ownership interest in the enterprise. So we're decreasing equity at this point. When we make a distribution, equity goes down. One of the most the clear example that many of you came up with in the first day of class was that, well, what is the return that investors get? And you said dividends, rightly so, is one of these forms. Distributions are one form of a distribution is a dividend. And when dividends are paid, remember first, dividends are recorded as dividends, I'll just shorthand it, and divs payable until they're paid. Once dividends are paid, then we don't have this liability any longer. This increases a liability. Now, when we have payment, we can reduce our dividends payable, and we will pay that in cash. Dividends are not always paid in cash, but common dividends are always paid in cash. Now, where does the decrease in equity come from? The decrease in equity comes from when these dividends, the original dividends account is closed out to retained earnings, and that results in a decrease to equity. So dividends decrease equity. It's a decrease in equity that stems from the company distributing wealth back to its owners. So I'm going to stop it here, and then we'll talk about the other flows that can occur in a company.